I'm going to do a bit of a lead-in and a context to why indeed I asked Roger to actually speak to the group. Have some time where Roger's presenting and opening discussion, and we'll close the evening, and of course there's drinks and food and the opportunity to ask Roger lots of hard questions and have a chat in that sense. So that's kind of the agenda. You know, there is a clear view of what constitutes high-quality organisations that Roger and the organisation, as you will hear, that Roger and the organisation pursues and shapes the way in which they invest. And, you know, obviously Roger's back, I'm sure many of you know, Roger's background is steeped in this area. I have his book. And, you know, when you look in this, for a start, it's called Valuable. And when you look in the book, there are, for example, Chapter 5 talks about picking extraordinary prospects. You know, what is an extraordinary business? And the whole philosophy of business excellence is trying to encourage people or enable people to actually create that kind of business. So here's Roger and Montgomery Investments trying to pick them, certainly from a financial investment perspective. You know that Roger's been on various forms of media, so, you know, ABC, Sky Business, ABC Radio, newspapers, etc., etc. So, you know, Roger has been voicing that for a while. My view, ladies and gentlemen, as you listen to Roger, is that you can be challenged about quality as it applies to you, having listened to it. I think Roger has a view about strategy, and of course, Roger gets to see how management actually is played out. So there are a number of perspectives that I think Roger can inform us about. Again, let me thank Roger for giving up the time and welcome him, please.
Okay, thanks very much, Alan. Thank you. I'm presuming you can hear me up the back clearly? Yep. Okay, great. All right, well, thank you very much for inviting me here. I'm particularly appreciative because it isn't raining inside. And it is outside and it's terrible. I am going to talk to you about quality from the perspective of a professional investor. Our job is simply to find businesses that we believe are going to create a lot of value. If investing is anything at all, it's the idea that we're putting a bit of money in now to get more back later, but not just more in absolute terms, but more in relative terms. And by that I mean we want to get enough to be able to preserve our purchasing power. So we think that there's a recipe for finding those businesses. We think they're relatively easy to find. When I was asked at lunchtime why I don't invest in property, my response was, well, shares are just too easy. Why would I bother with property? And I find investing in the stock market actually very, very easy. But it requires a perspective, it requires strategic thinking, it requires a framework, and I'm going to talk about all those things. I asked one of the guys at the office to put together a chart of our performance of our fund, our most recent fund, the Montgomery Fund, against a cohort of other fund managers. And I deliberately asked them to just pick managers that had done worse than us so that we were at the very top of the page. In truth, we are at the very top or very close to the top, and we switch around month to month with a couple of other managers in Australia. But more important for our discussion about quality is this chart here. What this particular chart shows is how much of the upside when the market goes up we capture in our funds versus how much of the downside we capture in our funds when the market goes down. If I stand here, you can't see me, can you? I'll move over here. Okay, so if you draw a horizontal line from this green dot over to the vertical axis or the y-axis, it intersects the y-axis at about 95%. In other words, since the inception of our fund, in any month where the market has gone up, we've captured about 95% of that upside movement. And that's despite the fact that since the inception of the fund, about 20% of the fund has been sitting in cash, which is a drag on your returns because it only returns a couple of percent. If you drop a vertical line from this green circle to the horizontal axis to the x-axis, you'll see it intersects at about 52%. In a market that falls, in any month where the market actually goes down, our fund captures only about 52% of that downside. Now, I'm not telling you this to market the funds. I'm telling you this because I truly believe that the focus on quality businesses actually works. and this is the evidence that it does work. Of course, month to month this will change, and over a longer period of time I presume it will change as well. However, I do believe, and there's plenty of evidence to show us that what we're focusing on are the things that we should be focusing on. But as I mentioned, it does require slightly different thinking. We think about businesses, not stocks, and I'm going to talk about all of that in just a second. So I'm going to talk about our framework and the financial framework that we use. I'm going to talk about management. I'm going to talk about management. I can answer. It's probably going to be best to talk about management in the Q&A, because I've met so many managers and so many financial planners in the investing community that I have a really good idea of what the bookends look like. And in the middle, it's just noise. And so I'll talk a little bit about that. And then I'll talk about fund managers and being a quality fund manager as well. So in terms of the investment philosophy, it's fairly straightforward, but more important than even this, or if we step back from this and go one step before it, what we're trying to do is we're trying to invest in businesses rather than stocks. What tends to happen in academia more than anywhere else, perhaps, is that there is a very clear focus on shares and their prices. So when we look at academic research on what works in the stock market, the evidence of something working is that the price went up. So for example, surprises, earnings surprises, when a company surprises the market with an upgrade, or it surprises the market by beating analysts' expectations or beating its previous guidance, there is a subsequent move in the market price that we can study, and we might be able to refine and regress some sort of result that says if you buy stocks where the underlying company announces a result that beats guidance by X percent, then what we find is on average the subsequent 4 days share price performance is 4% more than the market. And everyone sort of nods their head knowingly and goes, oh, that's really interesting and I'm going to try that. And then it doesn't work. But that aside, that's a study of price. It's not a study of the quality of a business. And so what we do is we actually put all of our academic study, we've got a couple of MBA duxes in our midst, and we don't do any of that. We're actually not interested in the stock market at all. What we're interested in is the underlying business and the underlying quality of the business, and we know precisely what to look for there. What we believe, and where the faith part of our equation comes in, is we believe that in the short run the market is random and the market actually won't reflect the underlying performance of a business, but in the long run it's very good at reflecting the underlying performance of the business and the quality of that business. Ben Graham, perhaps the founding father of security analysis, said it best when he said in the short run the market is a voting machine, but in the long run it's a weighing machine. And what was curious about that comment is he made it in the 1940s without the benefit of a computer. And I thought that's particularly insightful. So what are we looking for? We're focusing firstly on businesses, not stocks. By the way, betting on up or down, which is what a lot of people do in the stock market, is tantamount to betting on black or red. And they approach the stock market as a casino and scratch their heads and wonder why they haven't done very well. They also don't keep records, and so when something doesn't work, they haven't learnt from the experience and they tend to repeat the same mistakes. The other thing that we do, in addition to focusing on businesses rather than stocks, is we focus on value rather than price. We're not interested in the daily changes in price, although I have to confess some of my younger analysts really give themselves very large pats on the back when a stock that they picked has gone up 4%. We had 3 companies today whose shares went up more than 12% in the day, and they all thought they were very, very bright. Tomorrow, I'm going to we'll assume that tomorrow, because in the short run prices are largely random, we'll assume some of that will be given back, and I suspect that their very inflated heads will be deflated somewhat tomorrow in proportion to the change in the share price. But that's what they shouldn't be focusing on. They should be focusing on value and how a business increases in value. I'm going to talk about that today. We look for 3 Ps. We're looking for premium quality economics, so we're looking for very particular economic benefits that will ultimately adhere to an investor if they hold the shares of that business for long enough. We're after bright prospects. We're looking for a business that is going to grow. We're looking for a business that is bigger. Remember the comment I made earlier about putting money down to get more money later? That doesn't happen if the underlying business doesn't grow. Had a very interesting conversation with Dick Smith in the green room at the ABC across the road here. He believes that growth is the bane and blight of the world, and the pursuit of growth is its problem. And I actually have some sympathy with that idea. But in my short life and my requirement to provide for my children, I need to grow somehow, unless we revert to subsistence farming perhaps and barter. So bright prospects, and we need to be available, and these need to be available at a price below value. And we have also thought about a lot, not only about the quality of a business, but the quality of various valuation tools that are applied in the financial space. And you would have learnt this through your MBA programs, those of you who have attended. You would know that there's a whole variety of valuation formulas, some better quality than others. And we believe we've built something that's unique and proprietary that works very well. Okay, so when it comes to quality, this is my own view, and I tried to create a diagram that would convey this view to you. Quality is one of those things that you can I guess tackle from so many different angles and not arrive ever at the same place twice. And so what I've decided to do is just think about how I think about quality and then try and convey that to you. The first one is that I very much believe that quality when it comes to products or services that are provided by businesses is very much in the eye of the beholder. Quality, in the absence of a perception of that quality, ceases to exist. You do very well in philosophy giving that answer. You wouldn't need to attend any lectures or tutorials. You just have to say that the tree does in fact make a noise in the forest when it falls because animals get out of the way and they have ears and they can hear it. So perception is reality. What you think quality is quality to you, and I think you said that best right at the start. So for example, you can't see this up the back, but that is a pair of Adidas runners. And what's special about those Adidas runners is there was only ever one pair. It was a demo pair, if you like, and that pair of runners recently sold for $12,000. Now, the manufacturing process used to create that pair of runners was precisely the same as the manufacturing process used to create every other pair of runners. But these are somehow perceived better quality if someone is willing to pay more for it. Is that what we're talking about here? Are they better quality because people pay more? Not necessarily. They aren't better quality, but people were willing to pay more. Question mark around what quality actually is after looking at that particular example. What about Tiffany's? Tiffany's charges more for their diamonds than pretty much every other retailer. Are Tiffany's diamonds better quality? There's actually a global system for rating and ranking and scoring diamonds, and Tiffany's diamonds are no different to any other diamonds of the same quality score. Yet Tiffany's charges more. Do they have better quality diamonds? No. But girls prefer a Tiffany diamond. You know, they know when a man gets down on one knee and says, "Will you marry me?" What's your name? Mia. Mia. When a man gets down on one knee and says, "Mia, will you marry me?" Right? The man knows, and Tiffany's knows this as well, that you don't want to finish the sentence with, "And look, I saved 40%. Right? So Tiffany's knows this. And what I'm getting to, the point that I want to get to is this, that there seems to be a perception of quality that adheres in the price of that product. So if it's more expensive, we believe it to be better quality. But is it better quality always? In the case of Tiffany's, I don't think so. What about these Pandora bracelets? Does anyone have any experience with Pandora bracelets? Men, don't put your hand up. I'm not interested. Yep. Okay. So some people do. It was a man who put his hand up. What's interesting about this is some years ago on the side of the Linfield Kalara soccer field up on the Pacific Highway, I noticed, a whole bunch of 5-year-old boys and girls running around the field chasing a ball like moths around a light post, and not a good technique for winning a game. Nevertheless, they believed it was good quality. The women were shaking their hands and urging their kids to play really well, and what was draped off their wrists were all of these Pandora bracelets. So I'm a curious person. I think curiosity is a good thing. And so I asked them why they all had these bracelets. And they were telling me about Pandora's bracelets, and we got into the detail, and what they told me is, it's a real Pandora because when you take one of these charms off, it has a screw what's that? Yeah, it has the screw inside so it doesn't come off the end, and that's how you know it's Pandora. Presumably it's better quality because it has that screw feature inside. But you could go to any number of hawker markets in Singapore or Thailand or anywhere and buy the exact replica of that. It just won't have the screw inside. Does a screw really make for better quality? Why do the French not use screw tops on bottles? They use cork, not screws. So how does screws on a Pandora's charm make that better quality? It's all in your perception. It's all based on a story that's being told to you and which you allow yourself to believe. That's why you're willing to pay more for things that you believe are better quality. You as the customer determine what is quality. You as the customer anoint businesses. Now what happens, that's happenstance. That's not necessarily strategic. That first instance where someone invents a product or a service and launches it, and suddenly they see the hits on their website or their app going from 1,000 to 10,000 to 100,000 to 1 million to 10 million to 100 million users in the space of a few months. They weren't anticipating that. They were hoping, but hope, by the way, is not an effective business strategy. So they put it out there, they hope that it's going to work, and maybe it does. And that's happenstance. So what ends up happening is, in business, I believe, is that there are a lot of business managers who don't realise that they're lucky to be hanging on to the coattails of a product or service that has taken off simply because the customers have anointed it, not because they've done anything great. Do you really think that Facebook would have taken off if Zuckerberg hadn't invented it? Yes, I do. I think Facebook would have been Facebook, irrespective of who launched it. It wasn't Zuckerberg's wisdom. It may be now. There may be some strategic... presumably he's getting lots of advice too. REA, car sales, classic examples in Australia where when we meet with management and they tell us about what they're going to do, we always just have in the back of our mind this very large question mark about whether or not the success of that is due to them or whether it's this market anointing them. Think about REA. There isn't, in Australia, by the way, there's about 80 or 85 different websites that allow you to list your house for sale or your residential real estate for sale. There's about 80 of them. Many of them offer that service for free, and yet REA charges and is the biggest. Why is that? That's the network effect. Is it permanent? No, it's not. Is it good quality for now? But what about overseas? Management has tried to launch real estate sites in Italy and elsewhere, and they haven't been as successful. Or think carsales.com.au. I'm sure it's a site many of you have looked at. Why is it that that site has been successful, yet when they've tried to do the same thing in any other field, it hasn't been successful? Customers anointing business success, not necessarily management. So we are very, very sceptical. We do believe there's good management. I'm going to talk about what good management actually looks like. And when good management gets in a business boat with great economics, and when it gets in a business where the customer has anointed it, then for a time you've got a beautiful thing. You're going to make a lot of money when you invested it for that period of time. But what we're learning through disruption and everything that we're seeing in disruption is that nothing is ever permanent. You could have the best quality manager running the best quality taxi company, and yet Uber destroys it. So what was the relevance of that assessment of quality? Okay, lots of questions. Then what, of course, happens is business managers get arrogant. Arrogance is very, very common in business. And what they start to do is they want to grow the business. They want to proliferate the range of products that they offer, and then they start to destroy the very thing that they were fortunate enough to be a part of in the beginning. So examples of that, Michael Kors, Coach, and Prada, all have turned what was perceived to be a high-quality product into mastige, and they're now failing businesses. They're now really, really struggling. Have a look at their share prices and you'll see what happens when a company has too much arrogance and believes that everybody should have quality. We'll talk about more about that in just a minute. And then, of course, they crash and burn, or they reinvest. They reinvest appropriately, keep the product perhaps exclusive, and maybe it's exclusivity that equals quality. Again, just our perception, and it goes around again, and you get growth. So I've raised lots of questions about quality. I don't have the answers to precisely what quality is in every field, but what I know is what quality isn't. I know that, for example, Virgin Australia Holdings could have the very best corporate manager in the world, and they're rowing that boat, and yet that boat has a hole in the side of it. Qantas has a hole in its side. And at the moment it doesn't look like it does, but it does, and it will come back to haunt it when the oil price goes up. You see, with Qantas, those of you who've studied accounting, the problem is, of course, that depreciation, which is an expense on the profit and loss statement, is based on the historical cost of the aircraft. And for Qantas, it's up to 20 years with a 10% residual, and they depreciate them on a straight line basis over that 20 years. The problem, of course, is that when you buy a new plane to replace that 20-year-old plane, it costs a lot more than the one it replaced. And so accountants, by the way, accountants aren't regarded as very creative. Can I just suggest that they are the most creative people in the world? Because they are fabricating and inventing entries, line items on profit and loss statements to try and estimate the economic cost of running a business. If we replace depreciation with something called the provision for replacement cost of aircraft, then we'd have a much higher expense, and all of the plaudits that Joyce is receiving at the moment at Qantas wouldn't be there, because instead of a depreciation line item of $1.2 billion, they'd have a provision for replacement cost of aircraft that'd be $3 or $3.5 billion, and the profit that was reported would be a loss. There'd be no dividend, there'd be no return of capital, and there'd be no plaudits for Alan Joyce. So we know what quality isn't. We believe that when you've got management with the right characteristics getting into a business boat that has the right economics, we will do very, very well. Okay, so it was mentioned earlier in the introduction, the best businesses to own are businesses that tend to have competitive advantages, because what that competitive advantage does is sustain the ability to generate outsized returns. Competitive appropriation of information is so rife in business today that invariably a company will ultimately emerge to compete with you if you're generating outsized returns. And the only thing that will stop them doing that is if you've got something they can't have. So in the case of Tiffany's, it's history and legacy and a story, and having Hepburn in a movie called Breakfast at Tiffany's. You know, it wasn't breakfast at Michael Hill. It was breakfast at Tiffany's. And so Tiffany's can charge more for its diamonds because people believe they're part of that story. So, you know, they're about REA, for example. REA is in an industry where there are no barriers to entry. I mentioned earlier there are over 80 websites offering you the opportunity to list your house for sale, and many of them for free. And yet everyone uses REA, including all of the real estate agents. And why is that? Why is that? Because they have the network effect. They have something that others don't have. They have the network effect, and as I mentioned earlier, it may not last forever, but for now it's working. And what is the network effect? It's simply the idea that, or it's simply the observation that more people go to look at houses on REA because there are more houses listed. More houses are listed because more people are looking. And you have this virtuous circle occurring. Okay, so we've got high returns, which result from competitive advantages. They're sustained over a long period of time. And there is what we believe to be the most valuable of all competitive advantages, and sometimes we're even willing to pay more for the shares of a business where we can observe this, and that is the ability to raise prices even in the face of excess supply. REA just raised their prices for their premium ads, what are called their depth ads, on the 1st of July by 10 to 15% depending on your geography, and they did that despite the fact that there are 80-odd sites offering you the opportunity to list your house and for free. So that's what we're at. BHP doesn't have this. So in our mind, BHP isn't a good quality company, despite the fact that many others would say it's the best quality iron ore miner in the world, or it's the best quality copper miner in the world. We don't believe it's a great quality business, simply because if they raise the price of copper by 1 cent a pound, or they raise the price of iron ore by $1 a tonne, their volume goes to zero. It doesn't fall incrementally, it goes to zero instantly. And people buy elsewhere. They are forced to accept the market price. And our thought is that that is not a quality business. Okay, now we talked about growth briefly. We didn't talk about it actually, I only just mentioned it. We believe that there's quality growth and there is high quality growth and low quality growth or bad growth. Now, this is a little known quote from Warren Buffett. There are lots of quotes. Buffett's quoted all the time, but this is one that has not been explored a great deal. And what he said was this. He said, growth is good for the investor only when each dollar used to finance the growth creates over $1 of long-term market value. Let me demonstrate that for you. Here we've got a business with $10 of equity per share, generating a 20% return on its equity. Okay, there's one assumption I'm going to make here, guys, and the assumption is I don't know when the stock is going to be re-rated or derated. I don't know when the popularity of a company's shares will change. I'm no good at predicting market sentiment. I certainly couldn't have predicted that that pair of black runners was going to sell for $11,000 or $12,000. So I've got no idea about when habits are going to change or form, and when the hula hoop is going to be successful and when Pokemon Go is going to stop being successful. I can't predict those things. So I'm going to assume that as an investor, whatever the PE ratio is or the earnings multiple that I pay for the shares, that'll be the same one that I sell the shares for in the future. And that will be true for all the examples that I give you tonight. So this business has $10 of equity per share, generating a high-quality return on equity of 20%. Why do we call that high quality? Because it's much higher than what I can get in a term deposit. Okay? And basically what I know is when a company actually retains all of its earnings, when it retains all of its earnings and reinvests all of those earnings, your return on equity, if you buy and sell the shares, your internal rate of return, if you buy and sell the shares on the same PE ratio, will equal the return on equity of the business. And I want to generate the highest returns I can for our investors, which means we have to pursue businesses with high rates of return on equity, and we deem that to be good quality. So 20% on $10 is $2. The company pays the payout ratio is zero. The company pays no earnings as a dividend, so the dividends per share are zero. So the equity at the end of the year will be $12. So the equity grows from $10 to $12, and $12 is also the starting equity for next year. It earns 20% again, which is $2.40. Now, if you go back to Buffett's quote, it was, growth is good when every dollar used to finance the growth creates over $1 of long-term market value. Now, we know, by the way, that he wasn't talking about debt. You can finance growth through debt, but we know debt's going to get companies into a whole bunch of trouble sometime between now and 2020. We've got record debt all around the world. Corporate debt has gone through the roof, and 90% of the debt that's been accumulated by companies in the United States and in Australia since 2010 has been used for share buybacks, special dividends and mergers and acquisitions. Very little of it has gone to capacity improvement or productivity improvement. So what we're talking about here is not borrowings. You could also grow by issuing new shares and raising fresh capital, but of course that dilutes my ownership of the business, so we don't think that's good quality finance growth. So what we're interested in is retained earnings. So the question was, is this good growth or bad growth? Well, how much was used to finance the growth? $2. So $2 was retained in equity for the following year. And how much was that turned into? It was turned into $4. Without any re-rating of the company's shares, without any change to the popularity of the company's earnings. So that's good growth because $2 was converted into $4. Now what's really interesting in Australia, just as an aside, is in Australia shareholders demand dividends. They demand their dividends because the dividends come with franking credits because we don't have double taxation in Australia. And because the franking credits, those franking credits have no value to the company, they have value to the shareholders. So the shareholders will demand that this company pay a dividend. But clearly, the best thing this company can do is retain all of the profits. By retaining the profits and generating 20% on the retained profits, they generate a higher return for the investor. Warren Buffett's company Berkshire Hathaway is an example of a company that has done exactly this for 5 decades. Back in 1967, the share price of Berkshire Hathaway was around $40. It was 80-something dollars. And Warren Buffett paid a 10-cent dividend out of Berkshire Hathaway and wrote a letter with that dividend saying this is the last one you're ever going to get, because I can invest the money better than you, so I'll keep all of the money. He then proceeded to reinvest the retained profits at a rate of about 20 to 21% a year for 50 years. Those shares have gone from circa $80 to this year trading at about $216,000 each. So if someone wants income, what I do is I tell them sell a share if they've got Berkshire Hathaway, and if they want to have a good year, they sell 2. I think that's a really good quality outcome. Okay, so here is poor quality growth. Everything's exactly the same except the return on equity is only 5%. Not much more than what you can get in a bank account, although in relative terms at the moment in a low return environment that's a lot of alpha, and so people are very desperate to get 5% and they're willing to buy houses for a yield much lower than that. Let's see whether this produces a good outcome for the investor, this growth. The company starts with $10 of equity, earns a 5% return on equity, which is 50 cents, retains it all, so the equity rises to $10.50, which is also the equity at the beginning of the second year. Company generates 5% again, which is 52.5 cents. I've just rounded it there. So how much was used for growth or retained for growth? 50 cents. And what has the share price done? If we buy and sell it on the same PE, in this case 10, we get a conversion of 50 cents to 25 cents. You're an owner of this business. Imagine you're not a stock market punter or a stock market gambler. You're an owner of the business, and so this is your money that you could have received as a dividend. The management decided not to give it to you as a dividend. It's your money. They converted it instead into 25 cents for you. That's not a great quality outcome. So you would demand that they don't grow. You would demand, or you should demand, that they pay all of this out as a dividend. And what we find is the companies that tend to do this retain profits at low rates of return on equity. They are generally very low quality businesses. Perpetual low rates of return on equity tends to suggest that assets on the balance sheet are overvalued. The equity part of the ratio, profit divided by equity, the equity is too high. And we see time and time again, most recent example, Fairfax. Fairfax just wrote down the value of their mastheads and assets. Why? Because they were generating very low rates of return on equity. You don't want these businesses to retain money. The worst scenario is when you turn up at an annual general meeting and the company says, and you say, look, could you pay that money out as a dividend? You're losing half my money every time you retain $1. Could you pay it out? And they say, no, we need the money to grow. Your response would be, please don't grow. The next response that they might give, or another response that they might give, would be, actually, we don't need the money to grow, we just need the money to keep running in the same competitive spot. And that's an airline, ultimately. So either way you look at it, poor quality business and poor quality growth. Okay, here's an example of a poor quality business in real life. I've taken these numbers out of the annual reports. It's one of my favourite examples. Let's say, and what do we need to look at? It's really very, very simple. I've highlighted the 3 rows that we're going to focus on. I want you to imagine that you're investing in a business that I'm going to run for you. I'm going to be the manager of that particular business. You write a cheque for $400 million. Whoops, sorry, we'll go back. There we are. So you give me a cheque for $400 million to kick the business off. We also run down to the bank and we borrow $820 million. I run the business for a year and I report back to you $165 million profit on your $400 million investment. Suffice to say, you're absolutely delighted because it's circa 40% return on the equity you put into the business. You let me run the business for another 10 years. and you go off on a holiday, for example, I don't know, around the South Pacific on your yacht. You come back home, you put the fenders out, you come up to the mooring, you ask me down to the marina and ask how we're going, and I say to you, well, we've just lost $47 million. I'm going to presume that you're not delighted about that outcome. So you're going to then ask, is it a one-off? Is just an unusual year? No, last year we lost $317 million. And so you're not happy about that. And what you don't remember is when we waved goodbye to each other as you sailed off, you signed a limited power of attorney that allowed me to access your bank account to grow the business. We grew the number of customers that we serve. We grew our property, plant and equipment to serve those customers. We grew our geographical reach as well. So we grew the business. I would argue, if just looking at these numbers, you didn't grow at all. Okay, but we grew those aspects of the business. And in order to do that, I needed more money. So whereas previously you'd committed $400 million to generate $165, you've now committed almost $1.2 billion to generate a loss of about $360 million or thereabouts in the last 2 years. Not a great outcome. Your next question as a business owner would be, well, Roger, I'm going to hope that you've paid off that $820 million that we borrowed 10 years ago. No, actually, we owe the banks $2.5 billion. So let me just ask you, I mean, this is a conversation about quality. Is this a good quality outcome for you as the owner of this business? No, I've just described Virgin Australia Holdings. So this is the airline. And over the long run, what we know is look, I've already described a low quality outcome if you own the business. And I mentioned earlier that in the long run, the share prices tend to follow the performance, the economic performance of the business. This is a poor quality economic performance, and you'll get a poor quality share price outcome as well over that period of time. In fact, in 2003, when it listed about $2.15. It went as high as $2.60. It's now trading, I believe, it's trading at about 30 cents or 20 cents. You've heard the phrase, invest for the long term. Well, time is the friend of an outstanding business, not the friend of a mediocre or poor quality business. So you don't want to be investing for the long term in a poor quality business. Just as an aside, for those of you who are interested in the stock market, you'll note there are periods where the price goes up. And if you believe that you can buy the shares here and sell them here, and you believe that you can buy them there and sell them there, or buy them there and sell them there, if you believe that you'll be able to do that, can I just save you a whole lot of money and suggest that you also believe in the tooth fairy? Because that won't happen. It will not happen. I'm just trying to save you some money before you get out there and start investing. Okay, so what we're seeing at the moment is something, and I want to share this with you, and we're digressing a little, and apologies for that, but I really think it's valuable information. What we're seeing in the market at the moment is something that's going to result in a poor quality outcome for many investors. So what we're seeing is very, very low interest rates. In fact, the US 10-year Treasury rate, the Treasury bond rate, the 10-year bond rate in the US, is at about 1.55% at the moment. To put that into context, that's lower than at any time since the 1700s. And I was reliably informed today that it's lower. Interest rates today globally are lower than they were on an aggregate basis than at any time since the Roman Empire. I'm not quite sure how they worked out what the Romans were charging, but they have. What this has done is it's caused an income recession. So investors are not earning enough income. If you've got $1 million in a term deposit today, you're earning about $20,000, which is less than the poverty line. It's probably the first time certainly in my history, where I could say that if you're a millionaire, you're impoverished. And as a result, what's actually happening is investors are moving up the risk spectrum, investing in things with high dividend yields. So here is a business, and I'm probably describing Telstra here. Here is a business that has whose board has acquiesced to shareholder demands for more income, and what they've done is they've increased the payout ratio to 100%. And in fact, on the ASX 200, the payout ratio in 2011 was 55%, and today it's 80%. So we talked about quality growth before. It implies that you're retaining profits and generating high rates of return on those profits. So if companies are increasing their payout ratio, there's less profit being retained for growth. Yet these are the companies that people are paying the most for. So let's see how that works. Let's look at the economics of that, if you like, and it's only very simple arithmetic. We've got, sorry about that, this is a low quality device, with apologies to UTS. Okay, so we've got $10 of equity, another company earning 20% return on equity every year, but this time management acquiesced to shareholder demands for more income and pay 100% of those earnings out as a dividend, so the dividend is now $2. The equity at the end of the year is the same as the equity at the beginning of the year because guess what? Nothing's actually being retained. And so there's no growth in the equity. You can assume that's being eroded by inflation, so the purchasing power of your ownership stake in the business is deteriorating. And because the ROE is flat, albeit attractive, the earnings don't grow either. And so the dividend doesn't grow, and so your income isn't growing, and so your purchasing power is being eroded. But that's just by the by. If we make the assumption again that we don't know when stocks are going to become more popular or less popular, so whatever PE ratio we pay for the shares at the beginning is the PE ratio that we sell the shares for at the end, then we'll buy the shares on 10 times $2 of next year's earnings. So that's $20. We pay $20, it's an outflow of cash of $20. We receive $2 dividend the following year, another $2 the following year, and we sell the shares for 10 times the following year's earnings, which is $20. We get an internal rate of return of 10%. Why is that important? Because you'll note that it equals the dividend yield at the time you bought the shares. The yield when you bought the shares for $20, the dividend was $2, that's a yield of 10%. Why is that important? That's the maximum return you're going to get as an investor in this business. Unless you correctly gamble or speculate that the PE ratio is going to go up, and I've already said that's gambling. So as an investor, your maximum return equals the dividend yield at the time you purchase the shares, and the problem today is that people aren't buying shares on a 10% dividend yield, they're buying shares on a 3% dividend yield. Businesses are extremely risky. The stock market is extremely risky, and yet people are maximising the maximum return they're locking themselves in for on an asset that is arguably perpetual in terms of duration is 3% or 3.2% or 4%. That strikes me not as the new normal, which a lot of economic pundits are describing it as. It seems to me completely abnormal. There is an absence of logic in that. Okay. So here it is in action. Here's what actually happens to investors who invest in what they believe are quality businesses. I've just described Telstra, by the way. Telstra is described variously as a blue chip company in Australia. Blue chip describes or is a descriptor for quality. The best quality businesses are blue chip companies, and yet look at the outcome for investors. You've got $100,000 invested in Telstra in 2005 under Sol Trujillo. The payout ratio was 100%. It's got the highest yield though, so investors receive $5,970 on their $100,000 investment. Fast forward 10 years, because no earnings were retained, so there's no compounding going on, the $100,000 turns into $117,000, by the way, completely random, just based on the date that we decided to call it quits. So that's actually probably the same now, but a couple of months ago it was actually lower. And that just kept up with inflation, but look at the income growth. The income's gone from about $6,000 to $6,500. That hasn't kept up with inflation. Contrast that with a business that wasn't described as blue chip, but we knew it to be blue chip. We knew it to be high quality because it had the economics that we describe as being appropriate, and that is the ability to retain profits and generate high rates of return on those profits. So 100,000 grew 30-fold to 3 million 10 years later. And more importantly, the income of $3,900 that everyone thought wasn't enough per annum has grown to $99,800 per annum. So your yield in the 10th year is 99.8% on your original purchase price. So we believe this is quality. The ability to generate high rates of return on incremental capital and the ability to retain large parts of that capital and reinvest it profitably. That makes a quality business. So my suggestion to those of you who are changing careers or looking to go into an industry to begin with for the first time, my suggestion is walk into a business that has the ability to retain large amounts of capital and generate high rates of return on that capital. Otherwise, you may find there's no bonus, there's no salary increase, and if your union does give you a salary increase, it's at the expense of the profitability of the business, And we've seen many times in Australia, unions are willing to let businesses go broke rather than them back down on a wage increase. Okay, so that's the financial side and precisely what we're looking for in terms of quality. We're looking, I'm a capitalist. My wife doesn't like that, but that's what I do. And we are in the business, people are employing us and paying us to make money. We believe we can do that best over time by focusing on the financials that I just described. That's how we describe a quality business, and there are industries where there's a proliferation or a preponderance of those sorts of businesses. And Australia is a fantastic place to find those businesses, because what tends to happen in many industries in Australia is you get consolidation to the point of 2 or 3 or 4 players. So you get oligopolies forming, you get duopolies forming and so forth, and monopolies, and that seems to be the natural process in Australia. I think it's a function of the fact that we only have a very few people in Australia, and when a company lists, the impetus to grow involves paying for other businesses and buying them. Provided the ACCC doesn't get in the way, then you get monopolies and oligopolies forming. And oligopolies and monopolies is another source of competitive advantage that generates high rates of return on equity. By the way, another tip, if you're looking for a job, look for businesses that are oligopolies or in oligopolies or are monopoly businesses. Okay, so what does quality management look like? Well, that's a little bit harder to define. But I think the simplest definition is this one. What we're looking for are people that have a great deal of energy. Okay, so we're looking for people, you've heard the phrase, success is 10% inspiration and 90% perspiration. My brother and I grew up in the same household. We went to the same school. We had the same friends. And I worked really hard. Now, I had a good idea to begin with, and, I think there's a lot of happenstance in everyone's success as well. I think it's important to remember that. But 90% of it was just plain hard work. And you've heard people say, the harder I work, the luckier I am. In other words, more happenstance happens to people who are busier and working harder because people respect that. Okay, so...
What happened to your brother?
What happened to my brother? Well, he's still looking for a job. He's done different things. He's worked on a rig, on an oil rig. He's worked in a bike shop, and at the moment he's redeveloping a house that they bought. And that's it. Okay, so depends on your measure of success, doesn't it? Okay, it's all in the eye of the beholder. So Henry Ford I've used as a great example of somebody who I think epitomises a lot of the quality things that we look for in management. He disrupted blacksmiths. So he was a winner in the sense that he came up with a fantastic product and a fantastic technology, or he commercialised that fantastic technology, rather, that's to be more correct. And what he also did was disrupt other businesses. And so he had a lot of energy to be able to do that, because there would have been a lot of resistance. We're looking for management that are intelligent. When we hire our own team, we hire very, very bright people. We actually have an intelligence test that we give people. It's a very simple one. We give them 2 problems to solve. I'm not going to tell you what those problems are, because if you ever apply for a job, I don't want to give you a free run. So we're looking for very intelligent people. And intelligence comes in all different forms. We are looking for a very specific intelligence, but that's not to say that being creative isn't intelligent, or being a great salesperson. An emotional intelligence needs to exist in the most successful salespeople. We've hired the most emotionally intelligent people we can find for our sales team. So intelligence is vital, but above all else, when we interview management, CEOs of companies, we're looking for honesty. Now, it's very difficult for me to say this because I'm giving the talk, but there's a phrase in the Bible, I think it's in Proverbs, where words are many, the truth is often absent. When we interview CEOs, if they can't give us succinct answers, if they start rambling on and talking fast and giving us lots and lots of different possibilities, the truth isn't there. And we generally don't invest in those businesses. We're not interested in businesses that are run by people that are dishonest. I'll tell you why. Because if they've got these three criteria, you're going to do very well. You're going to make a lot of money, particularly if the business has those quality economics I described earlier. But if they have the first two characteristics and not this, they will kill you with these two. Their energy and intelligence will completely annihilate you if they're dishonest. So the most important characteristic that we look for in management is honesty. Interestingly, I'll give you a story, very quick story. A company called ABC Learning Centres. Does anyone remember ABC? I talk about it in my book. I was in the ABC studios when ABC Learning Centres was on its way to greatness. This is the greatness before the fall. And I remember I started saying on the ABC that this business was worth about 30 cents, and yet it was trading, its share price was trading at circa $8. And so, of course, all the media are interested in anyone who's willing to say that a business is worth 30 cents when it's trading at $8. And I proceeded to go on air and I talked about the business and I talked about why it was only 30 cents. The problem was that they were reinvesting capital at low rates of return. When they were a small business, they were generating a 40% return on equity, and as they got bigger, as they raised more equity to buy more centres, that return on equity became less than what you could get on a term deposit in a bank account. Why would you as an investor buy a business when, if the owner told you the return you're going to get is less than what you can get in the safety of a bank account? It makes no sense at all. So what then happened, no one wanted to give them any more money, partly because I was in the press saying this thing's worth a lot less and look at the returns on equity, so they started borrowing money. They started borrowing money and paying high prices for centres, and then of course it all blew up. But what was interesting is Eddie Grove sent me a letter, and it was a cease and desist letter, and I was really, really nervous when I got this particular letter. And I read the letter and it says, "You have made claims about our company and our management ability which we believe could be potentially defamatory. We ask that you retract those statements, take them off your blog and, do all these things." And when I looked down, there was no letterhead on it. So I thought usually, if it's Henry Davis York or if it's Mallison's, there's going to be... So I went all the way down the bottom and I found at the bottom of the letter the name of the company that had sent me. It was a PR company called Crook Media. And so I thought, there's another way I can assess management. If management of an Australian company hires a company called Crook Media to do their PR, then they're anticipating bad press. And presumably they're going to anticipate bad press because they're not doing something right. They're perhaps not honest. Just as an aside, interesting story. Okay. Now, I want to talk about funds management and finish up on this particular subject. I don't want to run out of time. Growing wealth is actually very easy to understand in business. If I have a bank account, with, let's say, $10 million in it, and it's earning a perpetual forever 20% interest rate. Now, you can't reinvest any of the interest. All of the interest is paid out as a dividend, so $2 million a year is paid out as interest to you from this bank account. Okay? I want to auction it tonight. Any bidders? Anyone willing to buy it for $10 million? It's got $10 million in it. Anyone want to buy it for 10 mil to earn 20% per annum? I'll buy it if you don't want it. I'm wondering if this is not a socialist group, is it? Is anyone interested? Who's not going to put their hand up no matter what I ask tonight? Right, okay, a few of you. All right, so I auctioned this bank account the other day on the Gold Coast. Let's put the Gold Coast to one side. But I auctioned it off on the Gold Coast at the Australian Investors Association annual conference, and there were people willing to pay $40 million for that bank account, guaranteeing them into perpetuity a 5% return. Okay, now you might think that's reasonable, you might think it's unreasonable, but the point is I could sell it for $40 million. If it was a $100 million bank account with all the same aspects and characteristics, then presumably I would have sold it for $400 million. Okay, let's think about that for a minute. What if I bought a bank account that had $10 million in it today, but in 10 years' time through the retention of profits was going to have $100 million in it and keep earning 20%? I could make a lot of money out of that, couldn't I? That's how businesses create wealth. That is a quality business to us. The faster it can grow that equity while maintaining its high rate of return on equity, the higher quality it is for us. because it's going to generate very high rates of return for our investors. So the way businesses generate wealth is really easy to understand. So a business that can retain large or high returns on incremental equity is the business you should work for, is the business you should own, is the business you shouldn't sell. Okay, we'll come back to that in just a second. So the other thing that we do, once we've got in mind how a business actually grows wealth and we want to own the highest quality businesses, the other thing that we need to do is we need to ignore the noise. A quality investor is somebody who has the ability, a quality investor is someone who has the temperament to ignore things that would make you jump at shadows. And I want to tell you a very quick story. It's 1919 and a company called Coca-Cola lists on the New York Stock Exchange at $40 a share. Now your grandmother or great-grandmother has bought this one share. Now before we tell this story, what are some of the geopolitical, macroeconomic things that might dissuade you from investing in the stock market? Or what are some of the things that might cause you to not want to invest in the stock market or sell your shares if they happened? Do you want to list some of those things that might happen in the world? Anything?
You're just talking about the timeline from 1919?
Yeah.
World War.
A world war. If a world war happened, would that be enough for you to be scared of investing and maybe pull your money out of the stock market? Okay, well, they had one of those.
The stock market crashed in 21.
In 27.
So 21 was the low.
So Coca-Cola's shares crashed in 1920 because there was a sugar crisis, right? And what happened, there was a sugar crisis, the price of sugar went through the roof, and Coca-Cola was providing the syrup to its bottlers, its customers, at a fixed price. So it was losing money hand over fist. So that following year, you're right, that following year the shares went from $40 to $19 a year later. Let's presume you held on through the sugar crisis. Then after the sugar crisis, you had the great crash of 1927. That might have been enough to scare you off, but you didn't. You held on. Then you had the Great Depression. 70% unemployment. That should have been enough to have you nervous and put the money under the mattress. But you held on. You kept holding on. And you kept holding on. Then we had World War II. You kept holding on. Then we had a nuclear missile crisis. We had the Vietnam War, we had the assassination of presidents, we had an oil crisis, we've had financial crises, we've had recessions, we've had stagflation, hyperinflation, we've had everything you can throw at investing to be scared of and to run away. Yet, if you held on to that one share back in 1919 rather, and took all of the splits as the company split its shares and reinvested all the dividends, and we maintain this calculation, you're now approaching $12 million. And if you'd bought a second share, that second share the year after when the sugar crisis was on, it's well over $30 million now. It's in fact closer to $40 million from investing $59. That's not a bad result. So we think quality investing, once you've found high quality businesses, you want to own them for as long as possible. We approach investing in companies the way we would a marriage, till death do us part. Unfortunately, shares are less faithful than my wife, and so sometimes we have to sell. And when we sell, we often, and we have often, regretted our mistake. We sold, for example, JB Hi-Fi, which is a company I talk about being a very high quality business in this book. And we bought JB Hi-Fi and we sold it at $19 and it subsequently fell to, I think, $15 or $16, and we tapped ourselves on the shoulder and thought, hey, well done, weren't we very smart? And we didn't look at it again because we thought it was all over, and in our arrogance we missed the fact that it was improving its performance again. It was growing faster, retaining a larger amount of incremental equity. It's now at $30. And so we've missed that. So holding on to high quality businesses and ignoring the noise, I think, is a very important thing to do. The other thing we need to do is not waver from what we're doing. We approach, and one way to approach the stock market is just our way. It's not the only right way. There's lots of other ways. But we approach the stock market much as we would having inherited a rural property, a farm. We've got lots of clients in agriculture. And they've inherited their properties on many occasions, and they have no intention of ever selling those farms. They have no debt on the property. They know they're going to have some bad years occasionally, but they're also going to have some very good years. And on balance, it's going to work out okay. If you approach investing in stocks or shares the same way, you'll do well. But what you have to do is you have to ignore the stock market's noise. The noisy stock market is akin to the farmer over the fence yelling out a price every single day that they're willing to buy your farm for, and a price that they're willing to sell you their farm. And that price is going to be much more volatile than the performance of the underlying business. So my suggestion will be, or is, to actually ignore that noise. The worst and the least useful, the lowest quality bit of information you can get on the stock market is that guy who comes on Combank in the late night news and talks about, what's his name? Tom Petrovsky. Everyone knows his name. That's a high quality name that people know. But, when he says this stock did X and that stock did this and the currency did that and gold did that and oil did that, that is an information-free zone. That is the poorest quality. Don't even bother. Don't waste your time. Okay. And the other thing is not to ever drift. And I'm sorry for the American Rifle Association image here, or the Australian Shooters Association image. See, girls can play this game too. It's for everyone using these sorts of weapons. The reason why I put this image up is I had a business, I had a funds management business that I founded in 2000. I listed another business under the same banner in 2004, and in 2007, July 2007, I sold that business. July 2007, if you don't realise this, is 6 months before the GFC actually hit. And the reason why I sold it is because it was a very good price, and I also gave a presentation with Robert Gottliebson, and I told our clients at the time, you will wake up one day next year in 2008 and the Dow Jones will be down 1,000 points overnight. The reason we knew that would happen was because we knew about the subprime crisis that was coming. We had a very good idea about that. 2 years after I sold the business, I was still working for the new owners, but what had happened is they were changing the way I invested. And so I left, I resigned, and I had a period where I wasn't allowed to work in the industry. And then I came back, I wrote a book and started a new business, Montgomery Investment Management. So Montgomery Investment Management is one of the top performing funds. The Montgomery Fund's one of the top performing funds in the country in its space. And the company that I left is, I think, the worst performing fund in its space. And I put that down to one thing and one thing only, what we call style drift. So a high quality manager will never change where the muzzle of the rifle is pointed in terms of their investment style. Because if you move the muzzle of a rifle 1 millimetre to the left or 1 millimetre to the right, then 3 kilometres down the road, the bullet's going to be an entirely different paddock. It will miss the target entirely. And so it's really important in funds management that we don't ever drift. And I see it as my responsibility as Chief Investment Officer at Montgomery. I don't do the grunt work anymore. All of the number crunching is done by very smart people, much smarter than me. But what I do is I make sure that they're never investing in things that aren't our style. I make sure they're never buying in a way that isn't our style. Because once we have style drift, we're no longer value investors in high quality businesses. And that's it from me tonight. Thank you very much for your attention.
So, folks, I hope you've kind of gleaned stuff to make good life choices. You've understood some things about high-quality businesses. From a personal point of view, Montgomery Investment, led by Roger, for me, as one of the market, I think about what Deming said, deliver what the market wants as an investor in a predictable and dependable fashion. I saw the graph, without making too many mistakes. If you can do that, you're going to cream competition. Roger, I think, with Montgomery Investments typifies that kind of quality organisation. So again, I know he's very busy. Thank you, Roger.
It's an absolute pleasure. Thanks very much, Alan.